All right, today we are diving into a massive financial crossroads for any business out there. How do you actually get the equipment you need to grow? This is one of those choices that can seriously make or break your bottom line. So let's jump right in.
It might look simple on the surface, but it's really not. The path you choose here, it impacts literally everything. Your cash flow, your tax bill, even your ability to compete. We're talking about a high-stakes decision that can shape your company's financial story for years to come.
So this is the big question we're going to tackle in this explainer. You need that new piece of machinery, that new delivery van, those new computers for the team. Do you buy them outright or do you lease? Let's break down what that really means.
Okay, so at the very top level, you've got two main roads you can go down. You can purchase the asset and own it, lock, stock, and barrel. Or you can lease it, which is basically like renting it for a specific amount of time. And believe me, each path has its own set of very different pros and cons.
And here is the fundamental trade-off, right? Buying is almost always cheaper in the long run, but man, it takes a huge bite out of your cash reserves up front. Leasing, on the other hand, is a lot gentler on your bank account month to month, and it also makes it way easier to upgrade to the latest tech. So the big question you have to ask yourself is, what are you trying to solve for? The lowest long-term cost or protecting your cash right now?
So let's say you're leaning towards leasing. You're thinking, yeah, I need to protect my working capital. You might feel like the decision's made, but hold on. This is where a secret layer of complexity pops up. You see, the word lease can mean a couple of very different things.
And that brings us to maybe the single most important distinction you need to get your head around. There are two main flavors of leases, a finance lease and an operating lease, and how they get treated on your books in a tax time is totally, completely different.
So first up, you've got the finance lease. You'll sometimes hear this called a capital lease. Now with this one, even though you don't technically hold the title, for all intents and purposes, at least in the eyes of your accountant, you're treated as the owner. The asset actually goes onto your balance sheet, and you're the one taking on the risks and reaping the rewards of owning it. Think of it as a clear path towards eventual ownership.
And then there's the operating lease. This is what most people think of when they hear the word lease. It's just a classic rental agreement. You use the equipment, you make your payments, and when the term is up, you give it back. The key difference here, the asset stays completely off your balance sheet. For you, those payments are just another business expense, plain and simple.
Okay, if all that accounting speak made your head spin a little, don't worry. Here is the absolute easiest way to think about it. Buying equipment with a loan? That's like getting a mortgage on a house. You're building equity. A finance lease? That's like a rent-to-own deal for a condo. You're using it with a very good chance of owning it in the end. And an operating lease? That's just like renting an apartment. You use it, you pay for it, and then you walk away. No strings attached.
So why do we even care about these different labels? Why does this matter? Well, because the choice you make has a direct, real-world impact on your company's financial statements and what you owe in taxes. Let's dig into how that actually plays out, starting with your balance sheet.
Right. A finance lease puts both an asset and a liability right onto your books. Now that changes important financial ratios, like your debt-to-equity ratio, which lenders look at very closely. An operating lease, however, is what we call an off-balance sheet expense. It doesn't pump up your assets or your liabilities, which can actually look pretty good if you're trying to get other loans or lines of credit.
And now, for everyone's favorite topic, taxes. In Canada, the rules are pretty specific. If you buy the equipment, you get to deduct something called the Capital Cost Allowance, or CCA, plus any interest you paid on the loan. Now here's the interesting part. For both finance and operating leases, you just deduct the lease payments as a business expense. A really common misconception is that a finance lease lets you claim CCA. It doesn't. You put the asset on your books, sure, but you're still just deducting the lease payments.
All right, that was a lot of theory. Now let's get super practical. How do you actually make this call for your own business? Well, here is a simple 4-step playbook that you can follow.
The process is really straightforward. First, you're going to start with the big picture strategy. Second, you do your homework on all the different options. Third, you've got to run the numbers. And finally, and this is key, you need to think beyond a simple either-or choice.
So, step one is all about asking some really foundational questions before you even start looking at price tags. How much can you genuinely afford? How stable and predictable is your cash flow? And do you actually have the people and the resources in-house to maintain and fix this equipment yourself? Now, when you get to step 3, comparing the numbers, it almost always boils down to this one thing, cash flow. If your cash flow is strong, it's predictable, you know it's coming in, buying is usually the best bet because your total cost of ownership will be lower. But If your cash flow is tight, or it's unpredictable, or maybe you're just in a huge growth spurt, leasing is often the smarter play to protect that precious, precious cash.
And that brings us to the final and I think maybe the most creative part of this whole strategy. You see, the best answer for your business might not be to just buy everything or to just lease everything.
I absolutely love this piece of practical advice because it gets you thinking about a hybrid approach. It's so smart. Lease the brand new, shiny, customer-facing stuff where appearances really matter. But for that workhorse equipment in the back room, the stuff no one ever sees, you can save a ton of money by buying it used. It's all about being strategic with every single dollar.
So ultimately, this whole decision is about reframing the question itself. Don't just think, how am I going to pay for this one machine? Instead, I want you to ask yourself, how is my entire equipment strategy, whether it's buying, leasing, or a smart mix of both, a direct and strategic investment in my company's growth and its long-term success?